how to get, so yeah, how to go ahead and get that. Let me put this in a group me so people gonna be in Kansas City to join. Let's see here.
So would the license be for the state of Missouri or?
Yes, it'll be state of Missouri, but you can get in what's called, once you pass this test, you can go get licensed in all 50 states if you choose. You just gotta apply for a non-residence license. You won't have to test again. All you gotta do is just go online, you'll fill out the application and pay whatever fee that state requires. Yep, so you'll be able to use this license in all 50 states. All right, so this one over here. All right, guys, so we're gonna go ahead and get started. Today we're doing the life licensing class, and so the objective today is 6 chapters in the life license class. Today we're gonna cover about half of it. The first 3 chapters, we'll come back 30, and we'll do the last 3 chapters. So I'm gonna give you some highlights on some things that's gonna be on the test, some things that usually trick you up. Your job is after this class, you go back and you fill in the gaps, right? Because I'm not gonna cover the whole book, but I'm gonna give you the stuff that they're gonna try to trick you on, what's pertinent to you pass the test, and so. Over 40% of the test, about 40% of the test is on the Missouri laws, rules, and regulations. So the last 2 chapters of the book, chapter 5 and chapter 6, is the bulk of the test. If you master that part and get a good understanding of the rest, you're gonna knock it out. So Missouri statutes, rules, and regulations is 2 chapters of the book, and that's the basics of it.
Okay.
If you go get that part mastered, like I'm gonna make sure I understand everything about these last 2 chapters, and then have a good knowledge of the rest of it, you're gonna knock it out on the first try. So nothing's really tough about this exam. It's just it's new information to you. And over the next 2 days, I'm gonna give it to you like a water hole. You're gonna get it all at one time. Don't panic, right? Because if you go home and you do the practice test, some of the stuff that right now that's gonna be a little bit over your head, right? When you go do that practice test, it's gonna say, hey, you got that wrong, but it's gonna say you're wrong, it's gonna tell you why you're wrong. So you're gonna increase your learning. So if you look at page 4 in your license manual, it's talking about the exam breakdown. So chapter 1 is going to be the number of questions on the exam is 12. It's going to be completing the application and delivering the policy. Completing the application, and delivering. What's the process of filling out and people applying for life insurance? You got to understand that process and then delivering that policy to them once they get approved. The second chapter is types of life policies. Notice there's only 12 questions on the test too. So there are different types of policies. Page 4. Yeah, so there's different types of policies. Whole life, universal life, all that, right? So there's really 2 forms of life insurance. You're gonna have cash value, you're gonna have term. But within inside those frames of cash value and terms, there are different types of terms, increasing, decreasing, right? Level. We're gonna break that down. There's different types of cash value. Whole life, universal life, variable life. So the difference between the 2 is how the cash component works. Right? The cash value policy got a cash component. They work differently. That's what we're going to focus on today. And not to say, oh, term is just pure debt protection. When you hear the word term, ain't no cash. So if you ever see a trick question on the test saying, term policy got cash, you know that's a trick. Cash value policies have cash. Term policies don't have cash. So whenever you hear that word, you know it's a trick because term is what? Pure debt protection. And when you hear the word term, that just simply means it's going to terminate at some point. It's temporary. That's what term insurance means. Chapter 3 is life policies, provisions, riders, and options. Life policies, provisions, riders, and options. So we're going to talking about, we know there are different types of policy, but what the provision and the clauses in those, right? And then number 4 is taxes, retirement, and other insurance concepts. So there's a way that we deal with taxes when it comes to a life insurance. A death benefit is never taxable. So if you die and leave somebody $1 million, they don't pay taxes on that million. Debt benefits are never taxable. Now, they put that debt benefit in some type of vehicle that draws interest and it accumulates more than $1 million, then you pay taxes on the growth. Does that make sense? Uncle Sam won't get his share of all new money, right? So we're going to talk about that. So that's the first 4 chapters, guys. And you notice it's only 12 questions here, 12 questions there, 18:8. But the last 2 chapters, right, it's the state law. That's 20 in each section. Those are the last 2 chapters. That's 40 questions on a 110 question test. So the bulk of it is those last 2 chapters. So that's what we're going to put to, Thursday. We're going to hit that hard. Because if you can master that and generally understand the rest, you're going to knock that thing out. So anyways, guys, the way we're going to do this today, we're going to go together, and we're gonna go through the chapters. I'm gonna give you some highlights, and then what we're gonna do is we're gonna come back and we're gonna go through the snapshots. That's at the beginning of each chapter. So on page 5, you see they got what's called snapshots. These gonna be open-ended questions, not multiple choice. The test is multiple choice. The snapshots is open-end. Now, why are we gonna do the snapshot? I'm just giving you homework to go do the multiple choice in the back of the back of every chapter. But we're gonna do the snapshots together. Why? Because if you can explain to me in your own words the answer, when they give you multiple choice, you're gonna eliminate what don't sound right. But at least you know the foundation of what is right. Does that make sense? Yeah. So we'll come back and do the snapshots as we go through the chapter. So we'll start on page 6, and it's gonna be key concepts while we're going through insurance, and I'll give you some things to highlight as we go through it. All right. So key concepts. Insurance is a contract in which one party, the insurance company, agrees to indemnify, make whole the insured party against loss, damages, or liabilities arising from an unknown event. So all it's saying, I want you to highlight the word indemnify. The word indemnify just simply means to bring you back to the state that you was in. Bring you back to the state that you was in prior to your loss. So all life insurance is that I got a Pinto. If I got a Pinto, the Pinto may be worth $5,000, right? Mm-hmm. If I got a Pinto and I total it out, they're not gonna allow me for the cost of a Bentley. So insurance is never for you to gain a profit. That's not what insurance is for. It's to bring you back to your current state. Does that make sense? That's what the word indemnify means. You ain't finna get no Bentley for a Pinto. You're gonna get a Pinto for a Pinto. So same way with life insurance. How you gonna ask for somebody to take out a $10 million policy on you and you don't stand to make $10 million over your lifetime? Nobody will lose $10 million if you die, so you can't insure yourself for $10 million while you live. Because people have to be interested in your longevity. See, if you put a $10 million policy, I think my wife loved me, but if I put $10 million on my head today, I'm gonna find out how much she really loved me, but I might be on the other side of heaven. You see, so right now, you can only insure yourself or somebody for whatever you can stand to lose. Does that make sense? That's what life insurance is, the transfer of risk for potential loss.
Would they insure you for $10 million?
Me?
Yeah.
Yeah, me, but not the average person.
Okay.
They'll insure me for $10 million because of what my income is. Okay. And they're gonna project and say, okay, man, over the next many years.
But the average person,
they can't get to, oh no. Because why would we insure you for $10 million? Somebody's going to kill you. You just put a bounty on your old head. Whoever that beneficiary, they're going to knock you off because you worth more dead than alive. Right. That makes sense? So people, whenever you take out insurance, you got to be interested in the longevity of the person that you take it out on. Okay. Like your wife don't want you to die. But put $100 million on you. The next argument, you out of here. So that's what you got to keep in mind.
You fell into the bus.
That's right. Yeah, I don't know how that, but we don't know how that happened, right? Yeah. So the second chapter says insurance transfers the risk of loss from an individual or business entity to an insurance company. What does it transfer? The risk of a loss. You got to stand to what? Lose something. That's the only way you can get insurance on. That's why you can't take out no policy on your cousin. What you gonna lose when your cousin die? Nothing. You can take one out on your mama. Right. You can take one out on your kids. But if your cousin died, you cry. You don't lose money. Nothing of monetary value. Does that make sense to you all?
Makes sense.
Right? So the transfer of a risk from a business or life, which in turns, right? So let's go back over. Insurance transfer the risk of loss from an individual or a business entity to an insurance company, which in turn spread the cost of that unexpected loss to many individuals. So when other people buying insurance policies from that company, they paying premium, right? They sharing in the risk. So one died, ain't like the insurance company only got money from you. They got policies from millions of people. So the premiums that they paying in is covering the risk because everybody ain't gonna die at the same time, hopefully. Does that make sense?
Right.
If there were no insurance mechanisms, the cost of a loss would have to be borne solely by the individual who suffered that loss. So in other words, if you ain't got no life insurance in place and you die, your wife got the whole risk of what your paycheck used to pay for. Mm-hmm. So you got to have insurance to make sure your wife is okay if you die. You got to have insurance so in case you total out your car, you can get another one. But without insurance, you bear that whole risk. You got to figure out how to replace that car. You got to figure out how to come up with $50,000. But if you got car insurance, you transferred your risk to who? The insurance company. You say, Mr. State Farm, I don't have $100,000. I don't have $50,000. But I got $50 a month to transfer my risk to you. So when you buy car insurance, you betting that one day you're going to crash. They betting that one day you're not.
Nah.
When you buy life insurance, guess what you're betting? Say it with me. You're betting that one day you're going to die. They're betting that they would have either made enough money off of you before you did, or that you elapse
Yeah.
before they
Right.
pay.
Right.
And most people that take out a life insurance policy lapse before they die.
Right.
So that's why the insurance industry is one of the highest paid industries, richest industries in the world.
Right.
Because they taking in a lot of money, but they ain't necessarily paying out a lot.
Right.
That makes sense? So life insurance protects against financial loss associated with an insured's debt and pays a death benefit to the beneficiary upon the death of the insured. The policy owner of the insurance contract pays premium to the insurer. The insurer is the company. I like that. Insurer, write the word company, because you're going to hear the word insured. That's the person that's being covered. You're going to hear the word insurer. That's the company. The insurer is the issuer of the policy. So Primerica is the insurer. I am the producer or agent. If my client is the insured, the person that's being covered. You got to know the distinction between the three, because they ask you a question and you think the insurer is the client, you getting that answer wrong just because you didn't even have clarity and definitions.
Right.
Does that make sense? So definition of keywords and concepts is important. All right. So in your own time, go the book box says terms to know. Make sure you go through that. The insurer is the insurer issues a policy covering the insured in the event of the insured's debt. The insurer pays the debt benefit to who? The beneficiary. So the beneficiary is the one that received the money when you die, right? Life insurance may be purchased by individuals or businesses. So an individual, you can buy as an individual, or a business can buy insurance. Because if I work for a company and I'm the president of the company, if I die, that company can take a financial loss. Why? Because they got to replace me. I ran the company. So my company can take a policy out on me because they're saying that we need to get time to put somebody in his spot. And while we're going through that transition, it can cause us to lose money. So we have an insurable interest, which is the next topic says on page 7 says insurable interest. To purchase insurance, the policy owner must face, whoever owns the policy, must face the possibility of what? Of losing money or something of value in the event of the loss. This is called insurable interest. In life insurance, insurable interest must exist between the policy owner and the insured when?
At the time of the application.
At the time of the application. So when you buy insurance on somebody else, that's the time when you got to have insurable interest. So you're married now.
Mm-hmm.
Your wife and you can take a policy out on each other. If y'all get divorced, she ain't got to give it back, because the insurable interest only had to be there at the time of the application. So it don't matter if y'all got divorced 10 years later, she can still keep that policy.
Mm-hmm.
I got an ex-girlfriend that still got a policy on me. Right now, we've been not together 15 years.
Mm-hmm.
And if I die before she do, she gonna get that money. But she just don't know she gonna die before me, right? So she waiting for the money. But she can keep the policy because we were engaged the time when she took it out. She had insurable interest. You work for the company now. We can take out a policy. Well, when you leave, we ain't gotta cancel it. Because when does insurable interest have to exist? At the time of the application. I had something to lose at the time we took that app out. Does that make sense?
Okay.
The next one we're gonna go down to is contract law. A contract is an agreement between two or more parties enforceable by what? Law. Because of unique aspects of insurance transactions, the general law of contract had to be modified to fit the needs of insurance. So here are the elements. This is number one, elements of a legal contract. Number one says, in order for insurance contracts to be legally binding, they must have 4 essential elements. Number one has to be the agreement. The agreement means they offered you something and you accepted it. That makes sense? So there's 4 elements of a legal contract. You got to have an agreement, they offered it to you and you accepted it. The number 2 is the consideration, right? Number 3 is the competent parties, that you can't be drunk and fill out for no life insurance, right? You're not competent.
Right.
And number 4, you got to have a legal purpose. So let's talk about the offering and acceptance. There must be a definite offer by one party, and the other party must accept the offer in its exact terms. In insurance, the applicant usually makes the offer when submitting the application. Acceptance takes place when the insurer, which is who? Who's the insurer? The company, underwriters approves the application and issues the policy. So the offer is from the applicant. You go sit down with a client, the offer is from them. Hey, I want to give you $60 a month for this $100,000 in coverage. Mm-hmm. Then the company look at it and they underwrite it and say, okay, we'll accept that. Now you have a what? Agreement. That's first stage one. Then you gotta have the consideration. The binding force in any contract is the consideration. What makes a contract bound is the consideration. Consideration is something of what? Value that each party gives to the other. The consideration on the part of the insured, the insured, the person that's being covered is what? Payment of their premium. That's what their consideration is. I'm gonna give you $50 a month. And the representation made on the application. So we're gonna ask you some medical questions. Your consideration is you're gonna pay this premium, and you didn't lie about these medical questions. This is what your consideration. This is what you got on the line, right? The consideration on the part of the insured is the promise to pay in the event of a loss. So the company saying, yeah, when you die, we'll pay you $100,000. That's our consideration. Your consideration is you pay us premium and you don't lie on the medical questions. Number three, got to be a competent party. The parties of a contract must be capable of entering into a contract in the eyes of the law, right? So somebody that's retarded can't take out a life insurance policy on themselves. They don't even know what they're doing. Somebody got amnesia, right? Somebody that needs a power of attorney. Somebody who can speak for them. They can't take out a policy. You take advantage of them. Does that make sense? Number four says they got to have a legal purpose. The purpose of the contract must be legal and not against the public policy. Not against public policy. To ensure the legal purpose of a life insurance policy, for example, it must have both insurable interest and consent, right? You can't take out insurance on your cousin. There is no what? Insurable interest. And it also has to be consent. So you can take out policies on people without them authorizing you to do it. Now, not your minor child. As a minor child, you take out all you want to. But you can't take out policies on baby daddies because the baby mama want to. Baby daddy gotta say it's okay. Baby daddy gotta sign for it. And if baby daddy ain't okay and if baby daddy don't sign, guess what? You can't take out the policy on it. A contract without a legal purpose is considered void and cannot be enforced by any party. All right. Distinct characteristics of insurance contracts. Contracts of adhesion. Remember this, highlight this, contracts of adhesion. A contract of adhesion is prepared by one of the parties, the insurer, and accepted or rejected by the party, the insured. So contract of adhesion is like, this ain't no negotiation. It's a contract of adhesion. This is what we gonna do. Do you want it or not?
Okay.
Does that make sense?
Yeah.
Because based on your age, your health, and your habit, they're gonna tell you what they can offer you.
Right.
You accept it or you don't. Well, no, $60 too much for 100,000. I'll give you 50. No, doesn't work that way. It's contract of adhesion. Insurance policies are not drawn up through negotiations, and an insured has little to say about its what? Provisions. Has little to say about its provisions. You don't get to have no say so. This is what they're gonna offer you. Take it or
Leave it.
that's what a contract of adhesion is, on a take it or leave it basis. Make sense? Let's talk about aleatory contract. Don't mess up these two words. Adhesion is take it or leave it. Take it or leave it. Aleatory contract, insurance contracts are aleatory, which means there is an exchange of unequal amounts of value, right? Aleatory contract, an exchange of unequal value. You just paid me $50 a month. I told you when you die, we're gonna pay you $200. That's unequal, unbalanced significantly. Does that make sense? So that's an aleatory contract. You giving, offering way more than I'm giving you in exchange.
Right.
So don't mix up aleatory contracts with contracts of adhesion. Contract of adhesion means what? Take it or leave it. Aleatory means that what? There's an unbalanced exchange, right? Unbalanced exchange. Aleatory contract, which means the exchange of unequal amounts or values. Unilateral contracts. In a unilateral contract, only one of the parties of the contract is legally bound to do anything. Let's say that again. Unilateral contract, in a unilateral contract, only one of the parties to the contract is legally bound to do anything. The insured makes no legally binding promises, right? The client don't make no binding promises. Unilateral contracts. If I go take out as an agent, I go write up a policy on a client, the client ain't got no binding promises that they making. None. The insurance company got the binding. As long as that client keep paying the premium, that insurance company got to pay the debt benefit. Right. So that's the binding contract. But the client can stop paying anytime they want to. Right. So they ain't bound forever or for no 20 years or no 30 years. They can stop paying tomorrow. But the insurance company can't wake up and say, you know what, I don't want to insure you no more. No. You signed that contract. The insurance company is tied to it. So that's unilateral, one-sided. Does that make sense?
Yeah.
And again, you got to make sure that you understand the difference between these two. What is aleatory? What is aleatory?
Unequal.
Unequal. Adhesion.
Take it or leave it.
Right. Unilateral.
Right.
One party bound. Right?
Yeah.
Conditional contract. As the name implies, a conditional contract requires that certain conditions must be met by the policy owner and the company in order for the contract to be executed, and before each party fulfills its obligation. For example, if the insured must pay the premium and provide proof of loss in order for the insurer to cover the claim. So that's conditional contract. We're not gonna pay you $100,000. Ain't nobody dead. You know what I'm saying?
Right.
That's what the insurance company asked for. The debt certificate. So you got to prove that it's time for us to pay. So that's a conditional contract. All right, so now we're going to talk about representations and warranties, right? All a representation simply means is that to the best of your knowledge. To the best of your knowledge. So whenever you take out a life insurance policy, with the bottom of page 8.
Is this gonna be my book?
Yeah, that's your book. Yeah, write all in it. That's all your deal. All right. So representations and warranties. A representation just simply means to the best of your knowledge. If I ask you medical questions, and let's say that I'm sitting down with a client, and I'm asking that client they medical questions, and one of the questions is, do you have AIDS? The client says no, but the client got AIDS. But the client didn't know they got AIDS. That's his representation. No doctors ever told him he got AIDS when he took out the application, so that's his representation. So if he died of AIDS, what does the insurance company have to do?
Pay.
They got to pay because that was his representation. To the best of his knowledge, he didn't have it. So he didn't lie on the application. He did not know he had it.
Diagnosed.
He wasn't diagnosed yet. A warranty is an absolute true statement. That's the difference between the representation and the warranty. Representation is to the best of your knowledge. A warranty is an absolute true statement. And the validity of the contract depends on that warranty. Right? Because a warranty, like think about a warranty on the car, that's a guarantee. So if I ask you, are you a convicted felon on the application, and they do, you know if you're a convicted felon or not, don't you? So a warranty, if you tell me you ain't no convicted felon, but you really are, guess what? You lied, and if you die, guess what?
You don't get paid.
We don't got to pay nothing because that was a warranty. And a warranty is a guarantee statement to be true, and the underwriters considered that statement when they made their decision. If you had told me you was a convicted felon, I probably wouldn't have allowed you to get $250,000. Well, you might only got $50,000. Why? Because the insurance is an exchange of risk. And the insurance company has to balance what risk they gonna take. If you are out here and you a convicted felon, you robbing banks or you shooting up people, they try to shoot up you,
Right.
so you more probable to die.
You risk.
So I ain't gonna put $250,000 on you. I might let you get $50,000, see if you be a good old boy for 10 years, and then we may be able to come back to the table. But the insurance company got to consider that. So that warranty is absolute. If they told you was diagnosed with AIDS and you knew it and you said no, that was a warranty. That voids the contract. Does that make sense? But so that's the difference. Representation means to the best of my what?
Knowledge.
And a warranty means
Absolute truth.
absolute
True
truth.
statement.
Right. So page 9, C. Process of issuing a life insurance policy. That goes through a process. So number 1 is solicitation and sales presentation. Right? Solicitation and sales presentation. That simply means you sat down with somebody and you solicited them. You did a sales presentation. Right? We sat down
right.
with you, right? We sold your policy, right, with your mom.
Yeah.
That we gave you a sales pitch. That was a solicitation. So whenever I solicit somebody from a life insurance policy, then I also have to give them a buyer's guide. And a buyer's guide just simply means I sold you what I sell. But there's some other stuff out here that you might think is in your best interest. So I give you a buyer's guide. And what does buyer guide do? It guides the buyer. That makes sense? It lets you know that, man, you could have chose some other company. Now, you sitting there saying, y'all didn't give me no buyer's guide. Y'all just sold me what y'all sold me, right? We did. We didn't give them no buyer's guide. Not going to give them a buyer's guide. But the law says that everybody you sell insurance to should get a what?
Buyer's guide.
So am I breaking the law?
Yes.
No, I'm not, because as long as the buyer's guide come with the policy, when he get his policy, there's gonna be a buyer's guide with
You
it.
don't
So
do
I
it.
don't have to give it to him up front as long as when the policy come, it's one included. Because he got a 30-day right of rescission.
Okay.
So that's what makes me legal, because when he gets his policy, he has a 30-day right of rescission. Right? You got it's called a free look period. Free look, you got 30 days. In our policy, it's 30 days, and you get 30 days to look over it and decide you don't want it. The state of Missouri regulates that every company, and that's the bottom of the buyer's guide, the last sentence says a 10-day free look period. Highlight that. Right? The last sentence is up on the buyer's guide. So in the state of Missouri, every company got to issue at least a 10-day free look period. So since that's a state law, guess what? Nobody has to leave with their client. A buyer's guide. Because when they get their policy in their hands, they got 10 days to look over and decide, hey, I see something better out here. And then they can go ahead and cancel it, and the insurance company got to give them back their premium. So the buyer's guide can come with the policy. You can give them one up front if you want to, but it don't matter if you don't, because they got 10 days to look at the policy from the date not from the day they get approved, from the day the policy get in their hand. They got 10 days from that day to decide, I don't want it, and if they don't, they get their premium back. Make sense?
Makes sense.
Policy summary. A policy summary is a written statement describing the features and elements of the policy being issued. If the policy, it must include the name, y'all need to highlight this part, it must include the name, the summary of the policy, must include the name, the address, and the agent, the full name and home office or administrative office address of the insurer, and the generic name of the basic policy and either riders. The policy summary will also include premium, how much premium they got to pay, cash value, dividends, surrender value, and death benefits. So if the policy builds up cash value, then they got to have that on this summary sheet. How much they pay a month. If they're going to get dividends. Dividends means that the insurance company made more money than they thought they was going to make. So they give you some of your money back that you paid in premiums. You got to have that all in the summary if it's that kind of company. And we're going to talk about that a little bit later on. So the summary must be provided when the policy is delivered. So whenever you deliver your policy, the front of every policy have a summary sheet. And it just summarizes what's going on with that policy. Does that make sense? So the policy may be this thick, but it's all summarized on one page. How much you pay, how long the policy for, do it build up cash value, will they pay you dividends? The summary sheet summarizes what you got. You ain't got to read through all that thick stuff.
Okay.
That make sense? So go with me to page 10, illustration. The term illustration, and highlight this first sentence. The term illustration means a presentation or depiction that includes non-guaranteed elements of a policy. Non-guaranteed, that's the key. Illustration is a depiction of non-guaranteed elements of the policy. Of individual or group insurance over a period of years, a life insurance illustration must do the following: distinguish between guaranteed and projected amounts. See, the illustration got to show you what are you saying guaranteed I'm gonna have in this money and in this policy, and what are you just saying could happen, so you can't mislead the client. That makes sense? Clearly state that an illustration is not part of the what? Contract. Why? Because it's an illustration, and the illustration is non-guaranteed elements of the policy. So that can't be a part of the contract because it's not guaranteed. Does that make sense? Third part, it says identify those values that are guaranteed as such. So what's guaranteed about the life insurance policy is the death benefit. But the moving part is if you borrow money out of your cash value, then that can change. So you got to depict that in your illustration. This is what's guaranteed to happen. This is what could happen. You got to separate those two so the client knows the difference between what could happen and what will happen. And what is the illustration? A depiction of non-guaranteed elements of that policy. So that's why the illustration, they're going to try to trick you. Illustration is a part of the contract. No, it's not. Why? Why isn't an illustration a part of the contract? Because it's not guaranteed. That makes sense? So let's talk about underwriting, right? Because you are the field underwriters. We ask the medical questions initially and all that, but then it goes to our home office and the real underwriters take a look at it and make the decision. We supposed to make the best decision that we can in the field because we're field underwriters. The company don't see the people that you're sitting with. You sitting with somebody and you say, do you use tobacco or not? And they telling you, no, I don't smoke, but you see blunts all in the ashtray. So you're the field underwriter. So now I don't tell nobody they lying, but if I see blunts, normally you smoke.
Right.
Now somebody will say, no, that's my cousin. My cousin, if I don't smoke blunts, my cousin can't come in my house and smoke blunts. He probably smoke it outside the door, but you ain't gonna I don't even got an ashtray for your blunts. So if a cigarette, what they call the thing you put it in, ashtray is in the house, the owner probably smokes. Would you all agree with that?
Yeah.
Nothing is absolute true, but somebody who pay rent that probably smoke if they got an ashtray with blunts.
In the house.
Even if I had a party and smokers came to the party, there would not be ashtrays in the living room.
Right.
So you are the field underwriter. You supposed to make the best observation for the company, because the company don't see that risk. You do. Does that make sense? So your job is to make sure that you giving the company the best chance to be profitable, because you want the company to be around for a long time. You building an agency. This ain't no we just selling insurance and making a little money. No, this is you building an agency that you gonna own.
Right.
And when you die, your kids take over. or sell it. It don't matter. Whatever you built it up to right now, we've been in 3 years, we had $300,000. Well, we can sell the business for $3 million, 10 times our annual salary. So do I want a company that got to write me a check today for $3 million to go out of business because everybody writing up bad business and people saying they don't smoke and we're not properly allocating that risk? If you smoke, you're going to die faster. Am I saying something incorrect? No, you're going to die faster. No, you're going to die faster. That's how it goes. So we got to get enough premium to offset that risk. Like you got car insurance, if you crash 10 times, your rates are higher. Why?
Because you be crashing.
Then you be crashing. They know they got to pay out something on you. Why do you think they charge the 16-year-old kids that get some insurance a whole lot of money? Because they got a three, 4 crashes in them. You 16? We're going to insure you. Oh, your mama probably can go about $300 a month because you got some crashes in you. And we need to get the money to allocate and proportion that risk properly. That's what underwriting is. Underwriting is the risk selection and classification process. I got to choose if I'm going to even select you. And if I do select you to take you on, I got to now classify you as to how are we going to what? Charge you. Do I want you at all? That's what underwriting is, the risk selection. Do we want you at all? And then our classification. How are we going to rate you based on what we know about you? Make sense? So let's talk about field underwriting. Field underwriting. The agent is the company's front line and is referred to as the field underwriter because the agent is usually the one who has what? Solicited the potential insured. As a field underwriter, the agent has many important responsibilities during the underwriting process and beyond, including the following: proper solicitation of the application, help prevent, highlight the second one, help prevent adverse selection. Adverse selection in the second bullet point is just risks that are more likely to suffer a loss. They smoke, they're on an oxygen tank, the company don't see that, you did. They sit there on an oxygen tank and you give them $1 million. That's a risk that's probably going to suffer a loss in a short period of time.
So how much would you insure them for? Say if they're on oxygen tank and they're trying
10,000, and it ain't gonna be through our regular carrier. Well, we can give them 30, but then we got a company that's on the side, not our regular company, that takes care of that kind of risk.
Okay.
It's called adverse selection, right? Adverse risk. They more likely to suffer a loss, so their premiums are gonna be much higher. So like I quoted a guy the other day, he's 77 years old. Now he good health is what his kids say, oh, my daddy healthy. I ain't never met a healthy 77-year-old, but he healthy. I know they out here, but I mean, just the probability of me running into the only one, you know, oh, my daddy healthy.
Right.
Well, the company already, that adverse selection company, they know he's 77, he got something, diabetes, he got sugar, he got something.
Arthritis.
Now, he got something, right? So they saying they don't care about him lying because it's an adverse company. They take on adverse selection, but they priced it out. They said, we ain't gonna give you number 10,000. And 10,000 cost that 77-year-old man $152 a month. Because they know he going to die.
Yeah.
So they already priced them out that way. So we got a separate company that take people with pre-existing conditions, if they severe. We don't put them with our base company. We got an adverse selection company, and they priced it accordingly.
Okay.
Does that make sense? All right,
So
so
you determine that, you just say, well, I'm gonna send you to my adverse company.
I'll tell them when I'm telling their profile is, I know it. I don't say it to them.
That's what I'm saying.
Yeah, in my mind, I'm like, okay, yeah, he ain't going here.
Right.
He's going to adverse selection. This is rate.
Okay.
So if I walk in the door with this, first off, number one, I can't write in my regular company nobody that's over the age 70 for a new policy. Now, we'll insure you up to age 95, but we can't write you as a new client over the age 70 because that's a preferred company.
So how do you make money out of that?
Out of the adverse selection,
Yeah.
they pay me commissions.
Okay.
Yeah, but it's less because I'm sharing in the risk.
Right.
So if I pick up an $84 check on my regular side, I'll make $1,100. If I pick up an $84 check on my adverse risk side, I'm probably gonna make $300
Okay.
because I'm sharing in that risk. Does that make sense?
Right, makes
Company know they're gonna die, so you're gonna pay you a little less. And then even the client got skin in the game. They got to pay more money and they got to live 2 years.
Okay.
If they die within 2 years of you writing, the company say, well, we can't be on the risk. You go, whoa, we got to give us time to make some money.
Right.
We can't be paying you this $10,000. You done paid us $84 2 months.
Right.
We're gonna be out of business.
Right.
So you gotta live 2 years. So what the company says that if you live 2 years, then we'll pay the death benefit. But if you die before 2 years, we just gonna give your family back the money that you paid, plus some interest on it. So it's an anything beats nothing policy. That makes sense. But everybody's sharing into that risk. But your job as the field underwriter is to help prevent or avoid adverse risk. Put them where they belong.
So is that policy, the adverse, is that still going to be a term life?
Yes, but it's term to age 100.
Okay.
Yeah, still go to age 100. It's term to age 100. Yeah, we don't do nothing but term. Go ahead.
So how long can you get a term? Can you get it for 50, 60?
Our term goes up to we do it up to a 35-year term.
35,
Yeah, so after 35 years. So we'll renew it after that, but it's gonna cost you more. So I may lock you in right now for $60 a month.
Right.
At the end of that 35, the 60 gonna probably turn to 100.
Okay.
But 35 years, you don't need as much coverage. You might not need no coverage at all if you've been investing. Your investments outweighed your insurance, so you see where your life is at that time.
Okay, so how do you make your investment? So,
You just add in a separate account. So we got a mutual fund account. It's a separate account.
so it's more, so say if your policy is $40, then that would be $50 and the 10 goes to your.
To your savings account. Exactly.
Okay.
Absolutely. Yeah. Exactly.
Because-
And they
you know, 'cause
determine
I
it.
got it, but, and I signed up for that.
Uh-huh.
Then the agent told me I didn't do it.
Yeah. Well, they probably talked about it and probably put more towards your premium, but we'll reevaluate your
Which
policy.
which was good, but she told me I never did it and never had it.
Had it in place yet.
And I definitely asked for
You
it.
remember you do it, yeah. So what we can do is reevaluate because you can always add it to it. We can fix it.
Okay.
Yeah, so we'll do that. So good. All right. So that's what you the field underwriting. You're responsible to make sure that the people the proper solicitation of application, helping prevent adverse selection, completing the application, obtaining the required signatures. Right, they got to sign, collecting the initial premium, and issuing a receipt if applicable. What they mean if applicable? You only get a receipt if you gave me some money.
Right.
Some people want to get a policy and see if they get approved and pay after that. No, give me some money and I'll give you a receipt.
Okay.
Because if you die and you're trying to see if you get approved, what if you die while you're seeing? Nobody gets nothing. But if you gave me a check and I gave you a receipt and you died, we pay. Because you can die in the underwriting process. See, if a client died while they're going through underwriting and underwriting trying to make a decision, policy ain't even issued yet, they died, they keep underwriting it as if they was alive. And they don't find no reason why they wouldn't have covered you, they're gonna pay the debt claim. But if you ain't paid no money and you die, the underwriting process stops because ain't nothing to pay. You're dead, you never paid us. Insurance is an exchange of risk. It's an exchange of risk. My $50 for your 100. What kind of risk is that? What kind of contract is that? Quiz time. Huh? What kind of contract? Unilateral.
Unilateral, yeah,
Unilateral, right? What does that mean? What does unilateral mean?
It's unbalanced.
Unbalanced. You gave me $50. If you die tomorrow, we got to give you 100,000. That's a unilateral contract. What's the take it or leave it contract? Adhesion, right? Take it or leave it. Unilateral, disproportionate, right?
Backwards.
So always remember that as we going through this, I'm gonna hit y'all back with some of the stuff that we already talked about as something else pro that, because you want to make sure you bringing this all together. Contract adhesion, unbalanced. Unilateral.
Take it or leave
Take
it.
it-
No, unilateral
No,
is
unilateral.
take it or leave. Unilateral is unbalanced.
No,
Adhesion is take it or leave it.
Know what you was asking?
Which one did you say?
Which one is take it or leave it?
Adhesion.
Which one is you gave me 50, but I'm gonna give you 100?
Unilateral.
Unilateral, right? What's the other two contracts we talked about?
Aleatory,
What does aleatory mean?
unequal exchange,
All right, unequal exchange of value. What's the other one that we talked about?
conditional,
Right, and we mixed it up. Unilateral means there's only one person binding on the promise.
Yeah, only one.
Only one person binding on
On
the
the
promise,
contract.
on the contract. Who's binding on the contract for insurance, on a unilateral contract? Who's bound to something?
The
the,
insurer.
The insurer, the company. They
Insurer.
gotta pay the debt claim. The client can stop paying anytime they want to, right?
right,
So that's unilateral, right? Contract of adhesion is what?
take
Take it or
it,
leave it.
Take it or leave it. Unilateral is,
Unbalanced.
unbalanced,
all right? So we gotta just make sure that you don't mix those up, because they're gonna get you on those questions coming down the road, like, or, and you're gonna be answering something that ain't got nothing to do with that. So make sure you all going through your, make sure you're going through your
Aleatory was unbalanced.
Aleatory means unbalanced risk. Unilateral means unbalanced, meaning that only one person is bound to it.
Okay.
Right, make sure
one
you
person is legally.
one person is legally bound. So as y'all reading the multiple choice test, you better make sure you lock this stuff in your brain. Does that make sense? Put it in your brain where it remains. Keep going through it. Make a rhyme out of it or something. All right. So the next thing we're talking about is the application. The bottom of page 10 talking about the application. So when the application is talking about, there's basically the application is a starting point and the basic source of information used by the company in the risk selection process. Although applications are not uniform and may vary from one insurer to another, they all have the same basic components. Part 1 is the general information, and part 2 is what? The medical information. So general information is your name, your address, your phone number, that's your general information. Part 2 is your medical information, your height and weight. You got diabetes, high blood pressure. What age was your mama when she died? What she died from? That's part 2. And then you got an agent's report. And an agent report is what you write down, the notation that you write down to the company. Like, I asked him, do he smoke? And he said no, but I seen blunts beside him. So you add that in your agent report. I never had to add that in my agent report, because when I see blunts, I say, now if you lie to me and say you don't smoke and then you die, and you do smoke, you void your contract. Because you lied to me saying you don't smoke, but told the doctor that you do.
Alright.
So guess what they're gonna pull? The doctor's report. They're gonna pull your doctor's report. So let's go ahead and just take a little bit less coverage and keep everything. Because you die, the whole objective of taking out insurance, so when you die, your family can get money, get paid. Make sense? Now your family gonna be mad at me, and they're gonna say Primerica don't pay out, but your butt lied. So I gotta help prevent what? Adverse selection. What's adverse selection means? Risks that are more likely to suffer a loss. I sink the blunt. I'm the what? Field underwriter. I'm the eyes for the company. That make sense?
Gotcha.
Require signatures. Down in the middle of the page up under the agent report, require signatures. Both the agent and the proposed insured, usually the applicant, must sign the application. Both the agent and the proposed insured. So whoever want to get the policy has to sign for it, right? And the proposed insured is usually the applicant, is the person that's taking it out on themselves. However, that's not always the case. A wife could take out a policy on her husband. The husband is the insured. The wife is the policy owner. So that means the husband got to what?
Sign.
And the wife, she's got to sign as the owner. He has to sign, giving authorization to own one on him. So we won't have no snap situation. He knows she mad at him. All of a sudden, like, she upset, now she want $1 million. We ain't never talked about this. So that's why you got to sign. Make sense?
Gotcha.
The next one says changes on the application. When an answer to a question on the application needs to be corrected, agents have the option, depending on which insurer, who is the insurer?
The company.
Right, which insurer they represent, of correcting the information and having the applicant to either highlight, initial the change, or complete a new application. So if you messed up on the application that you're taking out, most of ours are electronic, so we ain't writing it on paper. But if it was on paper and they messed up and you need to change it, you got the option to either correct that change and they initial it, right? They said non-tobacco, I had to switch it to tobacco. They initial it, said, yeah, that he didn't change that when he left my house. I initially said he did. We changed this and I knew he changed it. Or we can rip it up and start a whole new one over. But you should never, an agent should never do what? Erase or white out any information on the application. You just draw a line through it and change the answer to the right one and have the client initially. But never white out or never erase something. Because now you just manipulated the whole application.
Right.
So either start over or draw a line through what was wrong initially and put what was right.
Okay.
Never use white out, never erase.
They figured it was you when they did that yourself.
You could do that after you left.
Right,
And then can't nobody even see what you changed.
right,
If you white it out, does it make sense? So they want to make sure we're covering everybody.
right.
All right? Consequences of an incomplete application. Right? You may be sitting with a client and they don't want to go through the whole process. Right? And so if the client don't want to go through the whole process and you turn in an incomplete application, they didn't want to answer if they got cancer. Well, I don't know why you want to answer that. Why you gonna want to tell me if I ask you if you got cancer, why wouldn't you want to answer?
Right.
See, I live by a philosophy that no answer is a no answer. A no answer is a no answer. You telling me what you know already. When you say you don't want to answer it, you don't want to. I don't know. Yes, you do.
Yeah.
You know you don't want to tell me what you know.
Right,
Yeah. So no answer is a no answer. You got AIDS?
right.
You know.
You know, right.
You don't want to
You
answer
don't
right
wanna
now.
answer.
You already told me the
You gonna
answer.
say
I know the
yes.
answer because you
You
won't want
gonna
to
say
answer. The
no.
mere fact you don't
Right.
want to answer me.
Right.
Y'all got them kids like, did you sneak a snack? They ain't giving you no answer, but they just answered you, but they no answer.
Right.
A no answer is a no answer. I know the answer because
Right.
you know what I'm saying? So you got to think about that. So
No answer is a yes answer.
yeah, it depends on the situation, but I know what your answer is when you don't want to tell me. A no
That's a
answer,
no-
giving me
that's a no
giving me
on
no
that.
answer is a
Right.
no answer.
Right.
Does that make sense? So I live by that principle. So the consequences of an incomplete application, okay? So if you as an agent send the application to Primerica and it's not answer, and you did not answer all the questions, number one, we do it electronically, so it don't even let you. They don't answer all the questions, it tells you didn't answer it, get it answered, because we don't even want it until you answer it. But you can also have an option to fill out a paper application. Some people don't want to embrace technology, they want to fill out everything on paper and send it up through fax. And, you know, if you do that one time with me, we probably gonna switch teams. You ain't gonna be on my team no more. I don't like that snail mail. I like my stuff. It pay me quick, baby. So I'll go do it again. So if you send up a policy with answers that ain't answered, the question is not answered, then Primerica's job is to send it back to you to go get the answers. Now, if they don't, and they go ahead and issue the policy, and the person never answered if they got AIDS, and they never answered if they got cancer, and they die the next day of AIDS or cancer, guess what Primerica got to do? They got to pay the debt claim because they issued the policy without making them answer the question. So what they're saying is going to be interpreted as that y'all didn't need to know it. If you issue this policy without making them answer these questions, then that's going to be interpreted by law that you, the insurance company, don't need to know it.
Right.
So since you don't need to know it, pay the debt claim. Does that make sense? So they got to send it back to you and make you go get the answer. So flip it over. Premiums with the application, right? It's important. If you give me premium, you conditionally covered. If you don't give me premium, you're not conditionally covered. You can get covered when I bring your policy back and you give me a check, but if you died in between the policy getting issued and me getting it back to you and you signing off,
You dead.
you're dead. We had that happen. One of our agents sent in a policy, COD, right? If we don't know if we're going to cover you, we don't take money from you, right? If it's questionable, like if you got some situations, and I don't know, like if you schizophrenic, like we probably not going to cover a schizophrenic. We will on that guaranteed issue, adverse risk side, but we ain't going to do it on the preferred. If you got some diabetes and you ain't been taking care of yourself after getting it, we probably ain't. Anybody got diabetes, we cover diabetics. But I don't never take money from somebody with diabetes. Because I don't know what your doctor going to say about your regimens and what you've been doing or not doing. So I'm going to send you in COD. Huh?
I say if they unstable.
I don't know, because I ain't gonna know till I get the doctor report. So I'm gonna send you in COD, cash on delivery. Let the underwriter talk to your doctor, and once they talk to your doctor, then the doctor gonna come back, and then the underwriter gonna give me an answer. And once they give me an answer, I'm gonna come back and say, hey, this is what they said. They say you kind of do okay, but you ain't doing everything you're supposed to. So I can't give you this $100,000 for $50. It's gonna be $75. Do you want it? Contract of adhesion. Take it or leave it. You ain't no negotiation. Your doctor told us this, and this is what we offering you. Does that make sense?
Okay.
So if they take it, then they sign it, and I get a check. Then the coverage begins when I receive payment. Right?
Okay.
Now, if you gave me a check today, and you don't got no diabetes, nothing I sent it through, but you got a record of arrest and all the stuff you didn't tell me about, you conditionally covered. But if you had died and we found out that we wouldn't have covered you anyway, or issued the policy the way you applied for it, we ain't paying nothing. Even though you gave me a check, we're just going to give your family back your check. Why? Because we wouldn't have covered you anyway had we known what we found out.
So do you run a background check? Or
Yeah.
something? Okay.
Yeah, not on every case, but they sign up for it. We're going to check your background. We're going to order your medical records. We're going to even call your doctor if we need to.
Okay.
Do they do it on everybody? Nope. But see, they do what's called an MIB check, and we're gonna get to that. Medical Information Bureau check. It's on the next page.
Okay.
Medical Information Bureau is a non-for-profit organization where insurance companies share information with each other. You went to Reliable and tried to get a policy. You told them you got AIDS and you got declined. You come with Primary and say, I ain't got no AIDS. MIB report already said you told this to Reliable.
Right.
So if they see something different or contrary on the MIB report, it's gonna probe them because they can't make no decision based on what's on the MIB report. It just probes them to go dig further. Then they're going to get your doctor report. Then they're going to ask you for blood and urine. And all that stuff. They say, hey, buddy.
Something you ain't telling us.
Yeah, now we got a decision to make based on more information. Does that make sense? So we're going to do that. So anyway, so you give us money, it can cause you to have conditional coverage as long as nothing don't happen that you didn't disclose. Does that make sense? You don't give us money, ain't no coverage in place until we what? Exchange money. So when we get money, that's when coverage can potentially begin. Why do we get money up front and issue a conditional receipt? So in case you die, while the underwriter is making a decision, you got a shot to get this paid.
Okay.
But with no money, you got no shot to get it paid. Make sense? So we talked about the agent report. We talked about the company underwriting, medical examinations. At the bottom of page 12. For policies with higher amounts of coverage, or if the applicant raised additional questions concerning the prospective insurer's health, the underwriter may require a medical examination of the insured. There are two options depending on the reason for the medical examination. Number one, the insurer, which is the company, may only request a paramedical report. That means your doctor send them what they already know about you. That's what we use mostly, a paramedic report. Your doctor just sends us what they already know. Or you can do what's called a paramedic report. They're gonna send out, a paramedic report, they're gonna send out a doctor to take blood and urine from you. But you can get what's called an attending physician statement. This simply means your doctor just told them what they know about you. Your last checkup said this. It's called an APS, attending physician statement. The last time I attended my physician, this is what they said. And they can usually go just by that, if it's good. If not, they're gonna ask for a paramedic report and they're gonna send out a nurse. Like they came to you, they got blood, they got urine and all that stuff, right? So we can issue policies either way. People who want higher face amounts or a lower premium, we just give them a full medical underwriting. They come out, they're gonna draw blood, they're gonna get urine. And after they test all that stuff out, they're gonna say, okay, this is what we can do. Either they're gonna issue it as you apply it, or they're gonna make an adjustment. Does that make sense? It's because they're trying to prevent what? Adverse selection. A risk that's more likely to suffer a what? A loss. You don't buy insurance with money. Let me say that again. You pay for it with money, but that ain't how you buy it. You buy insurance with your age, your health, and your habits. The older you are, the more it costs. The more unhealthy you are, the more it costs. Your habits, the more it costs. And they also affect if you can get it at all. Your age affects if you can, at some point you're gonna be too old to get some anywhere. At some point your health will deteriorate where you can't get none anywhere. And some habits that you may have will call them say, we ain't messing with you. Make sense? That's how it works. This is the world we in. So page 13, Medical Information Bureau, the MIB, Medical Information Bureau. In addition to attending a physician statement report, the underwriter will usually request a Medical Information Bureau report. The MIB is a membership corporation owned by, underline, highlight, member insurance companies. So who owns the Medical Information Bureau report? Insurance companies. It's a nonprofit trade organization which receives adverse medical information from who? Insurance companies. Highlight that. They're gonna try to trick you and say you got they might be getting money, getting information from doctors and hospitals. No, doctors and hospitals can't share your information like that. It's insurance companies sharing information that they receive from a client with each other. Make sense? And maintains confidential medical impairment information on individuals. It is a systematic method for companies to compare the information they have collected on a potential insured with information other insurers may have discovered. The MIB can be used only in a what? Aid in helping the insurer know what areas of impairment they might need to investigate further. So it says an applicant cannot be what? Refused simply because of some adverse information discovered through the MIB, because MIB is just answer that you gave another insurance company. It ain't nothing from no doctor or nothing like that. The agent could have recorded it wrong. So it's just a guy saying, go check this out a little further. You can't make a decision on it. You can't decline nobody based on what's on the MIB report. The next two reports that they use is an investigative consumer report or an inspection report. So to supplement the information on the application, the underwriter may order an inspection report on the applicant from an independent investigation firm or credit agency, which covers financial and moral information. They are general reports of the applicant's finances, highlight finances, character, work, hobbies, and habits. So they would order an investigative report to look at your finances, your credit, right? Now, what my finances and my credit got to do with life insurance?
See how much you worth.
To see how much you worth, and also see if you're thinking about killing yourself.
Right.
Yeah, some people that's going to a lot of financial ruin, they got some other stuff when they buying. They consider all that, right? Applicants' finances, character, work, hobbies, and habits. Companies that use inspection reports are subject to the rules and regulations outlined in the Fair Credit Reporting Act. And the Fair Credit Reporting Act just saying you can't just pull no reports on people. They got to consent to it, and whatever you get, you can use for only a period of time against them. See, if they got bankruptcies, felonies, records of arrest that's over 7 years old, they can't use that. If the people only want 100,000 or less, say no, you ain't taking too much risk. If they did this stuff and it was 7 years ago and they only want $100,000 worth of life insurance or $100,000 worth of credit, you can't use that stuff against them. It was 7 years ago. They changed, and your risk ain't that big. It's 100,000 or less. So we can't consider those things, right? So flip over. So those are consumer reports and investigative consumer reports. You'll see on the third paragraph on page 14 where it says 2 years. Highlight that. Can't use stuff that's the reporting agency That's saying if somebody put something on a report that wasn't accurate, right? It says the reporting agency and users of information are subject to civil action for failure to comply with the provision of the Fair Credit Reporting Act. A person who knowingly and willfully obtained information on a consumer from a consumer reporting agency under false pretense may also be fined and imprisoned for 2 years. So if you're going to get information on somebody and you ain't supposed to be pulling these records and all that stuff, you can go to jail for 2 years. All right? If they got an investigative consumer report, that's the one right above it. Investigative consumer reports simply means that we ain't just gonna pull no reports. We gonna send out some people that's gonna go question your neighbors, your friends. They gonna do interviews on your neighbors and your friends. So these are people that may go and get 5, 10 million. They may do an investigation on you. But they can't just do that. They gotta let you know 3 days prior to doing it. Listen, we gonna investigate you. We gonna talk to your friends and your neighbors. They gotta let you know 3 days before doing it. And if they decline you or whatever, then you can say, well, what y'all declined me for? What my neighbors and them said about me? And if you request, makes sense? You can request the information and they got to give it to you within 5 days of you asking for it. So there's an investigative report. Just remember, if you see it's 2 types of reports, consumer report, that means they just pulling reports. Consumer reports. But if you hear the word investigate, think about a detective. They sending somebody out. And if they going to send somebody out, they got to let you know how many days before they send them out? 3 days before. Right? So that's right there in the second paragraph. They gotta let you know 3 days before. And then if they decline you and you wanna know what the people said about you, they gotta let you know that what? 5 days from when you asked for it. Does that make sense? The second and last paragraph says consumer reports cannot contain certain types of information if the report is requested in connection with a life insurance policy or a credit transaction for less than, sorry, it's not 100,000, it's 150,000. So if you requesting less than 150,000 coverage, they're saying, man, this stuff you can't use against them. What can I use against them? The prohibited information includes bankruptcy that's more than 10 years old, civil records, suits, records of arrest, convictions, or crimes, or any negative information that is more than 7 years old. So records of arrest and stuff like that that's over 7 years old, they can't use that against you. And if it's a bankruptcy, if it's 10 years old, they can't use that against you. So yeah, you can get these consumer reports on me. But if I'm applying for 150,000 or less in credit or 150,000 or less in life insurance, you can't be using a bankruptcy that I filed 10 years ago against me. You can't use records of arrest that happens more than 7 years ago against me. Why? Because I ain't getting more than 150,000. Does that make sense? So you can't consider that. You ain't taking on big enough risk to be tripping off, I got locked up 7 years ago. Does that make sense? Or I filed bankruptcy 10 years ago. The next section talks about the risk. Remember I said risk selection. Underwriting is the risk selection. What does selection means?
Are we going, where we at?
Page 15. Underwriting disclosures and insurance information. Remember we talked about the underwriting is the risk selection. What selection mean? Am I going to take you or leave you? That's the risk selection. But then after I select you, then I got to what? Classify you. Classify means how am I going to charge you, right? So risk classification, there's 3 types. You see where it says standard, preferred, and then you got substandard. Standard means you just like the general public. You average. You ain't too fat, you ain't too skinny, you just average. Ain't nothing special about you, just average. So you get the regular rate. Preferred means I prefer you over everybody else. That means, man, you in shape, you can run a mile. I mean, you sexy. That's preferred. I prefer you over somebody else, over the rest. Most people don't get preferred, right? And then you got substandard. Sub means you're under, below, high risk. You below what we looking for. You a little too chubby. You got some diabetes. We're going to insure you, but you're going to be substandard risk, which means your cost is going to be what? Higher. If you preferred, your rates are going to be lower. If you standard, they're going to be average. That's it. Nothing else to know about that. At the bottom paragraph, it talks about strangers originated life insurance policies. Stolies, strangers originated life insurance policies. Can you take out life insurance on a stranger?
No.
No, because you have no risk of loss. If you put an insurance policy on a hobo and they die, what do you lose?
Right.
Nothing. They're not related to you. Now, they came up with this because obviously some people was doing it.
Is it just with this company or?
No, period. This is the law. What we talking about ain't got nothing to do primarily. Everything we read today is the law. You can take the same information to State Farm. It's the same difference. All right? Unreliable. Reliable. It's the same difference, right? So, stolies, you cannot take out insurance policies on strangers. So in California, back in the 70s, insurance agents was taking out policies on hobos up on the bridges and killing them.
Wow.
And making somebody the beneficiary splitting the money.
Wow. Who's doing that?
Insurance agents.
Oh, man.
Yeah, very terrible. But you know what people do for money. That's why they come up with insurable interest, right? Yeah, you got to be interested in the longevity of the people, not their demise.
Right.
So you can't take out policies on a stranger. So of course the crooks didn't like that, so they came up with something else. On the next page 16 is called investors owned life insurance. So you stole these or it is illegal. So they came up with IOLI, investors owned insurance policy. That means that we own it, but we didn't originate it. So I go get Justin to take out a policy on himself. He can take out a policy on himself, can't he? Because he have insurable interest in himself.
Right.
And insurable interests only have to be there at the time. Remember I said if I'm with my wife today and we get divorced, we was married when we took it out. So insurable interests only have to be there at the time that the application is taken out. So if he take out a policy on himself, he have insurable interest in himself. Application is done, policy is issued. Now I can buy his policy from him. Because the insurable interest only have to be there when the application is taken out. He can sell me his policy. Now I own it. I didn't originate it though. He originated it. So now they just figured a way to get around it. I still want to take out policies on people who I ain't got no interest in. Because when they die, I want to get some profit.
Okay.
So I get him to take it out on himself and then I buy it from him.
And then you kill him.
Yes. yeah. Is that right? So that's how they come around it.
It was an accident.
Yeah.
But on
Strange.
the other side, how would that work?
Huh?
How would that work? Would you, if somebody wanted to buy? Like,
I sell it to him. I'm like, all right, this I got $1 million of coverage. If I die, I get $1 million. Okay, I'm 80 years old. I'm probably gonna die in the next 5 years. So you're gonna get $1 million in the next 5 years.
No,
So
basically, would you just take over my monthly payment or?
yeah, and we negotiate how much you gonna pay me.
I got you.
You're gonna get $1 million when I die. I'm 80. I'm probably gonna die in the next 5 years. Give me 300,000. You can have it. Cause I'm gonna need 300,000 to keep me alive to pay for my medicine. I ain't got no money.
Right.
Right? You always heard them J.G. Wentworth, 877 cash now. You need cash today. Call J. That's what they are. They buying life insurance policies and annuities, giving you money to suffice your living, right? Because you're trying to stay alive, and they gonna go and give you some kind of money. You got $100,000 life insurance policy. J.G. Wentworth give you 10 grand for it. They know you're gonna die anyway. So it's normally on old people.
And they
Accident
give
policies.
you
I mean,
the way that.
compensation policies.
It's all kind, but that's one they just specialize in. Yeah, you're gonna die, but you got all this over here. We know you're gonna die, but you need money now. You need cash today. Call J.G. Whitworth, 877 cash now. You need cash now.
Right.
You got this policy. That's gonna happen when you're dead. You need cash now.
And they make it seem like with the commercial, like it's like say you have a settlement.
You can too. They handle settlements too. They handle that too.
Yeah.
But life insurance. Guess what life insurance policy is when you die?
It's
A
a settlement.
settlement. It's how we gonna settle this? That's what it's part of the book. How we gonna do? What are your settlement options? Well, I sold mine to J.G. Wentworth. I settled up already.
Like,
Make sense? So you get them to pay. So it's a stranger's originated life insurance policy is illegal, but an investor owned the life insurance policy is not. You 90. Take a policy out of yourself and then come back and sell it to me. That ain't illegal. You took it out. I bought it from you. Should be, but not. So you know when you know the rules,
Yeah, you never.
yeah, you win the game. You just gotta know the rules, right? Yeah, you gotta know the rules. That's a good investment. You're gonna die in 10 days. Okay, take this out. Sell it to me. Anyway, so I wouldn't do it. You know, I'm a nice guy. I wouldn't do it. You know, depends on what my situation is. All right. So good. So let's move over. Effective date of the policy is when we get the money, right? If you ain't got the money, the policy not enforced. You gotta get money. People can get a refund. They got a how many day free look period? Company give you a free look period of how many days?
10 days.
10 days guaranteed. So if I got a 10-day free look period, what don't I have to give you when I show up?
The buyer's guide.
I don't got to give you no buyer's guide as long as this one going to be included in the policy, and the policy got a free look period. Page 18 talking about the USA Patriot Act. USA Patriot Act. What's the Patriot Act? Well, Patriot Act was after they did 9/11. So a lot of the money that funded that terrorist attack was in U.S. banks and insurance policies. So now when people put in a certain amount of money into insurance policy, you got to report it to the government. So you look on page 19, suspicious activity report, SARS. Highlight when you see 5,000. right? Somebody putting in $5,000 or more, right? And it looks suspicious, you gotta report that. Cause it could be terrorist acts or illegal things, right? And you gotta report it at the bottom of it, you gotta report it to FinCEN in the last paragraph within 30 days. So that's all you need to highlight on that. You remember they gotta report it in 30 days, if it's $5,000 or more, suspicious activity, you gotta report it, who you gotta report it to, FinCEN, all right? And you all can read through that on your own time. So that's chapter 1, guys. Let's go to the snapshots and see what our brains can remember. Let's go to our snapshots. Snapshots should be on page 4.
4.
Oh, no, that's not page 4. Where's our snapshots at? Maybe page 6. Let's see. Snapshots is page 5.
5.
All right, so snapshots. What is insurance? In your words, what is insurance?
Insurance, what is it?
In your own words,
To
just
bring you back to the state.
to bring you back to the state that you was in, that's indemnify. Insurance is a transferring of risk. My $50,
Already.
I got a risk of $1 million. If I die, my family, I'm worth $1 million. My family gonna lose this. That's what my earning potential is. So I'll give the life insurance company $150 a month to insure me for $1 million. So the insurance is transference of a risk for what? Potential loss. I could potentially lose this. So I need to transfer my risk to the insurance company. I got a car, it's worth $50,000. If I crash it, I don't have $50,000, but I can pay State Farm $100 a month. Transferring of a risk. Make sense? Number 2, in a life insurance policy, when must insurable interest exist? When do you have to have insurable interest?
When do you have to have insurance?
Yeah, I'm gonna take out a policy on somebody. I gotta have insurable interest. When does that must exist?
When you pay?
No. No. When, it's gotta be someone who's, that's gonna create a loss for you.
Right, but when does that matter?
At the time
Of the application. That's it. Insurable interest only gotta be there at the time of application. Doesn't matter if we married today, we took out the policy, we got insurable interest. Who cares if we get divorced in 10 years? I don't have to cancel my policy. Remember I told y'all my girlfriend still got a policy on me. My ex-girlfriend, sorry, wife, my ex-girlfriend. Ex-girlfriend still got a policy on me, right? So if I die, they still gotta pay her. Cause the insurable interest only mattered at the time of the what?
Application.
Time of application. Number 3, what are the 4 elements of an insurance contract? What are the 4 elements?
Agreement?
The agreement, right? We gotta have an agreement. Consideration, you gotta have something to consider. And what is the consideration for the insurance company? They got the money to pay when you die. What's the consideration for the applicant? The premium that you pay and the answers on your application. That's what we're gonna consider. We're gonna consider that you're gonna pay us this amount of money, and we're gonna consider how you answered your medical question. That's the insurer's consideration. The insurer's consideration is the promise to pay. What's another kind of contract?
Competent parties?
2 competent parties, they gotta be competent, right? The 4 elements, they gotta be competent. You can't be taking no life insurance policy out on somebody that's drunk or retarded, right? What's the 4th element?
Legal purpose.
Gotta have a legal purpose, right? All right, number 4. What does representation mean, and how does it differ from a warranty? What's the difference between your representation and a warranty? A representation is a what? To the best of your what?
Knowledge.
To the best of your knowledge. A warranty is what?
Guarantee.
Guarantee, absolutely
True
true.
statement.
Or you're a convicted felon. You say no, but it really was yes, you know that's a warranty. It voids the contract. Number 5, what does insurance solicitation means? What is solicitation?
Basically like selling something.
I'm trying to offer you something. I'm trying to convince you to get it. I'm soliciting you, right? Number 6, what information does a buyer's guide provide?
Buyer's guide provides you the opportunity to look at other businesses,
Other policies.
other policies.
Yeah, there ain't just the one I showed you. There's a different type. I'm a guide to buyer, right?
Let me
And
take you back for a second. What was the other one besides warranty?
warranty and representation.
Representation.
Yep, warranties and representation. Representation is to the best of my knowledge. Warranty is an absolute true statement, and the validity of that policy depends on that statement that you made. All right, what is underwriting? What is underwriting?
When you send it to the other guy to,
Select it.
Select it,
It's the risk
okay.
selection, and then after you select it, you gotta do what?
Send it off to,
I'm gonna select you. I'm gonna say we're gonna insure you, but now after I say I'm gonna insure you, what I gotta think about now?
I forgot what it is, but charge is.
Classification.
Classification, yeah.
And there's 3 classifications. Which are they? What is the 3 classification? You can be standard
standard,
Standard,
substandard,
standard,
and
preferred.
and preferred. Which one gets charged the most?
Substantive.
Which one get charged the least?
Preferred.
Which one get parts average?
Standard.
That's what all right, that's what, all right. So what information is gathered in part one of the application? Part one, there's two parts of the application. Part one gonna get what?
The general information.
Name,
Name,
Address.
Yeah,
right. What's part two?
medical.
Medical, height and weight, right? Diabetes, high blood pressure, all that, right? Number 9, what is the purpose of the agent's report? Why do you need an agent's report?
The agent's.
To communicate with the underwriter and provide information.
Right, you seen them put the blunt out, but they said they was a non-smoker.
Right,
Does that make sense? I seen them put a blunt out.
prevent law.
Yeah, adverse selection, your agent report, you're gonna give them your painted picture of it, right? Who is required to sign the application for life insurance? Who gotta sign?
The agent and the insured.
The agent and the insured.
Yeah.
And if the insured and the application owner ain't the same person, then the owner gotta sign as well. All right, baby mama takes it out on baby daddy. Baby daddy is the insured. He gotta sign.
Gotta sign.
Agent gotta sign, and baby mama gotta sign. Make sense? Number 11, when does an insurance policy go into effect?
When you pay.
When you get the money and the underwriters approved you, right? How can an insurance company use the information it obtained from the MIB? Get information from the MIB, what can they use it for? Can they decline you based on what the MIB said?
No.
No.
No, what they use it for?
I guess to investigate, see if they want
Further investigate.
Yeah.
It's an aid to go look at other stuff. 13, what is the purpose of a Fair Credit Reporting Act?
Purpose of the Fair Credit Reporting Act is that you can't just, pull a credit report.
And people's information, no, you gotta have authorization. Now, what if you get caught doing it and you ain't have no permission? How long you can go to jail for?
5 years and 2 years.
2 years, not
2
5
years.
and 2, it's 2 years, right? Your fine ain't go to jail for 2 years. Now, you wanna take 5, you just act up while you're in there. All right, so what is the difference between a consumer report and an investigative consumer report?
A consumer report is a basic report, an investigation report is one they really investigate.
They send people out,
people
send
out.
somebody out, and if they gonna send somebody out, they gotta let you know how many days before they do it.
5 days.
3
3
days.
days.
But if you wanna know what they found out, they gotta tell you within.
5 days.
That's gonna be important, all right? How does a substandard risk policy differ from a standard risk policy? Substandard versus standard.
Basically, it's more, I guess you would say, more of a risk.
More of a risk, so it's gonna cost you
More.
more money. There you go. What are the 3 factors that determines the premium for a particular policy?
Age, health,
Health.
And if you
smoke.
Smoke.
habits, it ain't just smoking. You could be crashing cars, racing motorcycles, like age, health, and habits.
And what,
All right. Number 17. When would an insured be required to sign a statement of good health? We didn't talk about this, but if somebody want to send in a policy without no money, and the underwriter say we're gonna approve you, then when you come back,
COD.
right, they send it in COD, then they approve it, you go back and you say, hey, did nothing change since I left, right? Sign this statement saying did nothing change since we left. Because the underwriter could approve you, but they approved you based on what they knew before you
Right.
came back. So now they gotta sign a statement of good health saying I'm still in good health, even since you left, and pay the money. So that's when that's required. All right, so we're gonna take a 10-minute break. Pause this. This is the end of chapter 1. On the life exam, we'll come back with chapter 2.